Cardi B is calling a financial crisis and no one has sold. Yield curve shows that we are still in complacency phase. Stocks are going down slowly and bonds are going down slowly too. Even gold and silver are losing in paper value this year. We are stuck in the eye of the storm for a while now. There is nowhere to hide but in cash. Dollar bills, yo. Everyone is bearish. Even mainstream rapper Cardi B tweeted, "The interest rate is going up in 2 weeks. And rent is over the top high." FedEx CEO just warned that we are going into a worldwide recession. And yet data shows that no one has panic sold yet. This only proves one thing: the party hasn't started yet. Or are we still at the top? Yield curve shows we do. And Michael Burry has left Twitter's sphere. See you soon. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back, everyone, to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these markets, consider subscribing. It's totally free. And of course, tap the like button if you've enjoyed today's video. It's totally free to do so. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl. If you want to be my good boy, apply to write your first book with me. Author of best-selling books, Goddess Cheryl. You will get the encouragement you need to be on your author journey. My good boys always obey. They always do everything I ask of them. They never say no. How are people surviving? I want to know. You know that my family and my friends, they are so grateful to have me. But it's just like, yo, what happened to the people that don't have a Cardi B in their family? She said, I knew that this was going to happen. I knew they were going to have a financial crisis. Wow, this is going mainstream. Even the pulp culture now are talking about financial crisis. And yet, check this chart out. No outflow of U.S. household equity flow compared to last recession. No one has panic sold yet. Even the VIX hasn't even spiked higher than 30 yet. The music has started, but the beats haven't even dropped yet. The world stage is set, but the war hasn't started yet. Remember March 2020 crash? It's all AI trading now. They can sell the market down faster than Mach 10 with Maverick. Just think about how fast does Netflix dropped a couple months ago, and how much fear a market can crash when a truth crisis appears. In 2020, the VIX hit over 80. In 2008, the VIX hit close to 90. We are sitting at 26 right now. Nowhere close to be a truth crisis movement. We should not have FOMO here. The 2020 crash trained investors to buy the dip, build the position fast, and hold it until they pump it up. Because opportunity window was so short, most people were feeling the pain of FOMO. This time the market is dragging. It's really slow. There are huge windows of opportunities to buy some stocks, but not all stocks are cheap yet. That's because no one has felt any gut-wrenching pain like they have suffered a huge loss. Because we all have recency bias. What happened most recently after the market crash? It went up and make a series of new highs that had happened twice in the last 5 years. First one happened in 2018, trade war with China, the Christmas crash. Apple lost almost 40%. Nvidia lost 57%. Second one is 2020. That's just a trade war. This time could be a real war. U.S. financial institutions are holding a lot of China's real estate debt. China's manufacturing is experiencing blackouts. Chinese middle class is running on the banks. China's demographic are upside down and it's getting worse. 80% of the goods you buy from Amazon, Walmart, Target, and dollar stores are made in China. 55% Tesla's revenue last quarter were made and sold in China. China is threatening to take over Taiwan. US says that it won't happen. When the Pearl Harbor was hit by Japanese fighter jets, US was the last to know. They were surprised. When you look at the yield curve on Friday, this is what you see. You can see 6 month to 1 year has the highest rate or yield, but the 3-month yield is still down. And that's the key. Every time when we have a crisis crash, 3-month yield needs to be higher than 6 months and 1 year yield. Check out these signals from charts. This one is from February 24th, 2020. This one .com crash was from October 23rd, 2000. This one, the Great Recession from February 20th, 2007. All these signal dates happen before the actual gut-wrenching waterfall like crashing. We still haven't seen the 3-month signal yet thus far. This might sound very scary, but what we have seen so far is what you see at the complacency phase at the top. Look at this signal from May 15th, 2000. That's the top of the market before the crash. This is what you see at the bottom of the market. This one from September 19th, 2002. The yield curve going straight up. This one from February 3rd, 2009. This one from April 2nd, 2020. Right now, by the looks of it, we have a long way to go down. We haven't even got 3 months to 4% yet. When the Fed keeps raising the Fed funds rate, it will get there. How to prepare for it? One of the biggest arguments for buying stocks over the past decade is getting obliterated by soaring cash yields. Over the last decade, a big argument for buying stocks was the fact that interest rates were at rock bottom, leaving few alternatives for investors. But now there is no alternative or TINA argument for stocks is getting obliterated. That's because cash yields or risk-free returns on short-term treasury bonds are soaring as the Federal Reserve continues to hike interest rate. The Fed has hiked interest rates by 225 basis points so far this year, and next week he's expected to raise rates by another 75 basis points. All in, investors currently expect the federal funds rate to stand above 4% by the end of the year. Well, some have argued that the Fed needs to pause its interest rate hikes because of the underlying damage to the economy. Subramanian suggests history shows that it's better for the Fed to be overly cautious about rising inflation in the long term. Lessons from the 1970s tell us that premature easing could result in a fresh wave of inflation and that market volatility in the short run may be a smaller price to pay. With everything from stocks to bonds to crypto to gold falling substantially this year, Subramanian's argument may resonate with a lot of investors, especially considering that uncertainties have skyrocketed amid Russia's war on Ukraine, surging oil prices, and depressed consumer sentiment. A 4% cash yield provides a real alternative to stocks, justifying lower multiples versus the last decade with TINA. And given that inflation remains stuck around 8%, the S&P 500 could continue its decline because its forward price to earnings multiple of 16.7x is far too high. Subramanian said stocks are cheaper but still not cheap. Subramanian estimates that there's only a 20% chance that the stock market has fully priced in the economic recession. We remain bearish. And my client, Teddy Eazzy, Wicked Pussy Perfume. It's an erotic novel. And my book, Joy, the Spell of Magic. This one is an incredible read. I will post the links for you below. And Lightning and Thunder, Discover Who You Are. This is another one of my books. Thank you for liking my video and subscribing to my channel. I thank you for being a fan. Goodbye.